income statement, also known as the profit and loss statement, is a financial report that shows whether a company earned a profit or incurred a loss during a specific period. It presents revenues, costs, expenses, and finally the net income in an organized manner. In simple terms, this statement answers the question, is the company generating profits or suffering losses? This statement is very important because it allows us to evaluate the company's actual profitability, supports strategic decision-making, measures operational efficiency, and provides relevant information for investors, banks, and other stakeholders. In short, it is a key tool for understanding the financial health of a business. To analyze it effectively, we first review how revenues have changed, whether they are increasing, decreasing, or remaining stable. Then, we analyze the cost of goods sold to understand how much it costs the company to produce or acquire what it sells. We also review the gross margin, which reflects the company's core profitability. Next, we examine operating expenses to identify whether they are under control or have increased unusually. After that, we evaluate operating income, which indicates how efficient the company is, before considering interest and taxes. Finally, we analyze net income, which shows the final result, whether the company earned a profit or incurred a loss. This analysis can be complemented with ratios such as gross margin, operating margin, and net margin, which help compare performance across different periods or with other companies. In conclusion, the income statement makes it possible to evaluate a company's profitability and financial performance. Its analysis helps identify strengths, weaknesses, and opportunities for improvement, and based on that, supports more accurate decision-making. Understanding this document is essential for any professional seeking to properly manage an organization's resources. Now, I will give the floor to the Accounting News segment, where you will see two outstanding accounting professionals who will share valuable information and insights.
Welcome to today's episode. We're going to take a quick look at the income statement, a crucial tool for every business owner. It's more than just an accounting document. It answers the fundamental question, does your company actually make money, or does it just sell?
Thanks for having me. It's great to be here. That distinction is vital. The income statement reveals how a company generates sales, the cost involved in production, operational expenses, and what's left at the end. It's not just about glancing at the net profit. It's about understanding how that profit was achieved.
Let's dive right in. Some businesses boast impressive revenue, but suffer from poor margins, while others have moderate sales but maintain solid internal control. The income statement sheds light on this balance between efficiency and volume.
Exactly. Let's start from the top. The first line is sales. Many assume that more sales automatically mean more profit, but that's a common misconception. Sales reflect market acceptance, not financial health.
Until you subtract the cost of sales, you know nothing. Companies that purchase materials at high prices, produce inefficiently, or generate waste end up eroding their margins. This brings us to gross profit, the difference between what you sell and what it costs to produce or purchase those goods.
And from there, we derive the key metric, gross margin. It's calculated by dividing gross profit by sales. This percentage indicates whether your business model creates real value. A gross margin of 20% or 30% is healthy, but if it's down to 8% or 10%, your business is extremely vulnerable.
Relying solely on volume to survive means any market shift can be detrimental. Fewer sales with the same costs can quickly wipe out your entire gross profit.
Remember, the income statement doesn't tell you why your costs are high. It prompts you to investigate. Are your suppliers expensive? Is your logistics system inefficient? Do you have poorly managed inventory or operational problems?
After gross profit, we enter the realm where many companies falter, operating expenses. This includes everything that keeps the business running: administration, sales, marketing, salaries, rent.
Some companies sell well and have reasonable costs but suffer from a bloated administrative structure. Non-value-adding personnel, poorly designed campaigns, or unnecessarily expensive rent can all erode operating profit.
Operating profit is what's left after subtracting operating expenses from gross profit. A revealing metric here is the operating margin, calculated by dividing operating profit by sales.
This percentage shows how well the company is managed, not just how much it sells. A low operating margin indicates that the organization consumes more than it can sustain.
That's when owners say, I don't know why I have no money if I sold a lot. Yes, you sold, but perhaps to cover excessive personnel, services, or poor planning.
Then come the silent elements, other income and other expenses. Here we see if the company is in debt, pays bank interest, or had non-recurring income like the sale of assets.
And then there's taxes, which many underestimate. If you're paying them, it means you've generated profit. Net profit, the last line, is what truly remains. To reinvest, pay dividends, or accumulate capital.
But it's not just about making money or not. A low net profit can be part of a growth strategy, investment, or expansion. It can also signal an inefficient structure.
An analyst doesn't just look at the final figure. They examine the whole story: revenue, costs, expenses, taxes, and the final result.
The income statement isn't just a form for the tax authority or the accountant. It's a leadership document. It tells you how you produce, how you spend, how you finance yourself, and how you generate value.
And the best part is that it lets you anticipate. If your gross margin is low, rethink suppliers or processes. If the operating margin is weak, adjust structure and expenses. If net profit is poor, review financing, pricing, or commercial strategy.
Numbers don't lie. Sometimes they hide, but they never lie. The income statement is the map to find them, if you know how to read it.
Absolutely. To illustrate, let's consider a practical example. Take a company with sales of $1,000 and a cost of sales at $650,000. This results in a gross profit of $350,000, giving a gross margin of 35%. However, with operating expenses totaling $220,000, the operating profit drops to $130,000, yielding an operating margin of 13%. After accounting for bank interest and taxes, the net profit stands at $77,000, with a net margin of 7.7%. This scenario shows that while the company sells well and controls costs, its operating expenses consume a significant portion of the margin.
That's a great example. It highlights the importance of not just focusing on sales, but also managing costs and expenses effectively to ensure a healthy bottom line.
Exactly. Understanding and analyzing your income statement is crucial for making informed business decisions and steering your company towards sustained profitability.
Well said. Thank you for having me on today's episode. It's been a pleasure discussing this vital topic.
Thank you for joining us, and thank you to our listeners for tuning in. Remember, your income statement is more than just numbers. It's the story of your business's financial health. Until next time.
Well, today's session was very interesting. I hope you enjoyed it and found the information useful. Thank you for joining us, and we'll see you next time.